Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Thanks for joining us again here at AusBiz. Let's get across what happened overnight. Now, equity markets mixed amid escalating tensions in the Middle East, with President Trump vowing to respond to Iran shooting down a US helicopter that was patrolling the Strait of Hormuz, and US forces having enacted on that threat. I'll get to that in a moment. But on Wall Street, a rebound in tech shares fizzled, sending the S&P 500 and Nasdaq lower. The Philadelphia Semiconductor Index dropped more than 8%, but recovered to end around 2% lower. And the CBOE Volatility Index hitting its highest level in 2 months as stocks sold off. Investors are also bracing for US inflation data out tonight, which may point to the need for interest rate hikes. Now, among the chipmakers which were hit hard during Friday's sell-off, Broadcom fell while Nvidia, that was down slightly. Apple shed around 3.5%, with the stock having hit a record high the previous session. The biggest movers on the S&P 500 were Supermicro Computer, which fell heavily, while snacks maker J.M. Smucker and logistics giant FedEx were among the best. Shares of network tech company Ciena fell after it announced pricing on a convertible debt offering. And anticipation is building ahead of the SpaceX IPO, which is set to become the largest ever, with it so far drawing more than $250 billion of investor demand, dwarfing the $75 billion the Elon Musk-led company is seeking to raise. Well, US Central Command in the Middle East has said its forces have begun launching self-defense strikes against Iran in response to the downing of a US Army Apache helicopter. It says the aircraft was brought down by an Iranian attack drone, with the 2 pilots ejecting safely. Iran has denied responsibility. Explosions have been reported around the Iranian coast at the entrance of the Strait of Hormuz. President Trump saying the shooting of the helicopter meant the US must respond at a time when he said negotiations with Iran were in the final throes of what he said would be a very, very good deal. Well, the US Federal Reserve will hold its key interest rate for the rest of the year, according to a majority of economists in a Reuters poll. Inflation has risen to roughly double the Fed's 2% target. And the Reuters poll forecasts that tomorrow's inflation data is expected to show it climbed more than to a 3-year high of 4.2% last month. Well, US Treasury yields have dipped as traders await that CPI data. The 2-year falling to 4.12%, the 10-year was down to 4.53%. The Australian 3-year government bond yields fell to 4.51%, the 10-year at 4.91%. The US dollar index down slightly. The Aussie is trading lower at 70.2 US cents. Oil prices initially fell to a 7-week low after Iran and Israel said they had halted attacks on each other. However, the downing of a US helicopter and its subsequent retaliation has pushed crude higher. Brent crude currently at around $92 a barrel. Gold has fallen to a more than 2-month low amid rising expectations of a US interest rate hike this year. Spot gold down around 2% at $4,260 an ounce. Copper futures are off slightly. Iron ore at 102 US a ton, and Bitcoin has fallen below 62,000 US dollars. Well, joining us now is Anu Ganti, head of US Index Investment Strategy at S&P Dow Jones Indices. Anu, terrific to have you back. A lot to talk about just as far as what's going on Wall Street at the moment. Now, of course, we saw equities rally over the course of May. It has been a bit of a different story to begin this month of June, in particular, given what we saw, that sharp sell-off on Friday. What are your observations about what you're seeing in the market at the moment?
Yes, it is great to be here, and it's certainly been a roller coaster to watch. And what I like to think of it is sort of as a tug of war, right? Because on the one hand side, you have the enthusiasm that we've seen for AI-related stocks, and specifically a handful of chip makers driving the market. But on the other hand, you have concerns, including concerns about inflation that are persistent. As you mentioned, we have the upcoming CPI report tomorrow that we're looking ahead to. We're seeing the rise in oil prices, and we've got geopolitical concerns to deal with. So that's the other side of it. So it's really the market and the market sentiment of balancing these opposing forces, if you will. And we saw that sharp sell-off on Friday. We had the sharp recovery yesterday. We're down again today. So there is certainly certainly a lot of volatility here. You mentioned that the VIX index, which measures implied volatility, rose sharply as well. So a lot of jitters in this market right now.
So I know if we look at the performance, particularly in the S&P 500 year to date, it is very narrow. In fact, I think we've got a chart just illustrating what we're seeing there right now.
Yes, it certainly is narrowing of breadth. And there's a simple way to measure the performance of breadth in the market, which is the percentage of stocks that beat the index. What you're looking at here is you've got the Mag 7 on one side, you've got the five top performing S&P 500 stocks, all of which were not in the Mag 7, but a handful of chip makers, as mentioned, contributing roughly 25% to the market's gains year to date, which really goes to show the extreme narrowness of this rally. And it's been interesting to watch that trend to go from the reversal, because initially in the first part of the year before the war, we started to see a broadening of the market. We started to see smaller caps outperforming, and then we saw this sharp reversal with the return of the large caps, and specifically the return of the semiconductors and the chip makers.
So I know it is that time where investors are trying to pick the winners and losers, particularly in that AI trade. How is this playing out in terms of the dispersion that you're seeing on the market at the moment?
Yes, that is the question of the day, and we track dispersion very closely because it's a measure of opportunity for skillful stock pickers. And we have seen that stock level dispersion has risen to extreme levels. Prior periods of extremes include post the financial crisis, during the heyday of the 90s tech bubble. So there certainly is opportunity, but we would like to caution, of course, if you have the skill to do it, right, which is the big question of the day.
Yes, all right, just trying to pick those winners and losers. Certainly not easy at this point. So when you then take a look at the best performing and the worst performing stocks, what have you noticed there just in terms of that market breadth overall?
Yes, and we've done a lot of analysis on historical conditions for active managers, and we looked at prior periods of high dispersion and low dispersion, and we tended to see that active managers did slightly better in higher dispersion periods. What you're looking at here is, of course, the decline in breadth, with only 24% of stocks beating the index in May, roughly down half from 67% in February. And interestingly, we looked at active manager regimes of low breadth and high breadth regimes. And in fact, we exactly saw what we expected to see, which is that active managers fared worse, had a tougher time in those low breadth, narrowing breadth periods. But even in the high breadth periods, we still saw majority underperformance, which really goes to show that the game is still tough, regardless of market condition.
All right, so the question, I guess, for investors now, as we head into the second half of 2026, what we can look forward to, just in terms of obviously that dispersion and, to your point, I guess, the opportunities you're seeing for stock selection at this point.
Yes, it's an interesting time to take stock of where we are as we look ahead to H2. We have an index called DSPX, which uses listed options to measure the market's expectation of dispersion the next 30 days. That number, last I checked, it is roughly around the 41 handle. So potentially opportune conditions that the market is perceiving in the future. The market is expecting higher dispersion 30 days from now. So that could signal potential positive tailwinds for stock pickers. But again, we'll caution that if we continue to see that narrow breadth in the market, that could be a headwind. Of course, you're looking here at the one-year performance after an S&P 500 all-time high. The average was 7.5%. Typically, after we saw an all-time high, we tend to see another all-time high. But there were really extremes in the market. For example, if you think about October 2007, we were at an all-time high. Subsequently, we went into a tough bear market. Then think back to October 1996, we were at an all-time high. Subsequently, went into a bull market. So it's really tough to predict this in advance.
So, Anu, given where we're at, given where those valuations have soared to, what lessons can we draw on perhaps some history? Because there are a lot of parallels being drawn with the dot-com bubble of the early 2000s, of course. Is that relevant? And I guess particularly in terms of the lessons and warnings, potentially, particularly for those high conviction managers.
It's an excellent question, Andrew. There are certainly a lot of parallels that we can draw on the tech bubble of the 90s and lessons to think about. I think one of the lessons is it's very tough to predict a bubble in advance. Having said that, it's important to understand the volatility conditions that we're in. What kind of dispersion environment are we in? What kind of breadth environment are we in? How do things look across the cap spectrum? Are smaller caps leading, or are larger caps making a comeback as we're seeing right now? Because all of that can play a signal into the overall health of the market. And I will say, one, we look at sectors very closely. The tech sector of today is very different than the tech sector of the 90s. And there's a lot more quality, more robust. If you think about the companies that are within our S&P 500 Information Technology Index compared to then, which may be a positive sign. So there are some similarities and some differences as well.
Anu, always terrific to get across what you're seeing in terms of those movements on the S&P. Thanks for joining us from S&P Dow Jones Indices.
Thank you.
Let's now turn our attention to the local markets. So we're looking for a positive start. Mind you, we said that yesterday, and look what happened. We were down dramatically to begin the session, but steadily climbed throughout the day to finish almost flat. So S&P ASX 200 futures pointing to 13 points higher to begin the session on this Wednesday. Bearing in mind we have had futures on Wall Street have fallen. That's subsequent to that news that the US has retaliated against the downing of a US helicopter in the Strait of Hormuz. We'll across that and much more. Join us for the Open.